What's going on, guys? Welcome back into today's episode of Money Moves. This is our episode for the week of October 15th.
Yeah.
And things are heating up. Election is heating up.
It's
How many days do we have left? 21 days.
Let me double check.
Officially, we're heading into earnings season. We'll get a little insight on where things are going there. We've got some economic news and data that's coming out. We'll try and sort through all of the different headlines that may be talking about the bubble in certain areas of the economy popping, some being bullish. We've got the CPI and PPI reports from last week to unpack a little bit.
Yep.
Rate cuts. Will there be any more this year?
Absolutely.
We'll look to kind of dive into a lot of different things. So that being said, starting off with the political train, sounds like from reports this week, both Trump and Kamala might be on Joe Rogan coming up very soon. I would be highly shocked if Kamala went on a long-form podcast with someone like Joe Rogan. That would be
eat her.
That would be dang. I just can't see it.
Oh, I know she's doing things right now to try to save face because she's polling the lowest that she's ever polled as far as like probability. I don't care what the national poll's saying. I'm talking about betting odds, real money, which is.
Well, let's talk about that. Where, it looked like Donald Trump has widened his lead pretty significantly
according
from
to
the betting polls. Polymarket, which actually allows you to bet on the election.
Not U.S. You have to use
Kalshi is the other one, right?
Kalshi is the first regulated. Polymarket, you're not allowed to bet there if you're in the United States, but a lot of people still do because they use a VPN or a workaround via crypto. But it is the largest predicting and betting market in the world, and it is, in my opinion, more accurate right now than Kalshi because it has more volume to it, more money, almost $2 billion versus about $5 million on Kalshi.
Oh, Kalshi only has 5 million?
Yeah.
Oh, that's really small.
Yeah, very small.
I thought it was bigger.
No. So Trump's currently sitting at a 58% chance of winning, and Kamala Harris is at a 42% chance. He has trended up 2.7% in the past 24 hours. Kamala down 2.5%. If we go to the balance of power right now, it says there's a 57% chance that a Republican president is elected. There's a 55% chance that we have a Democratic House and a 78% chance of a Republican Senate. 40% chance of a Republican sweep, only a 16% chance of a Democratic sweep.
Okay.
Meaning that there's a almost 50-50 chance that we actually take the House, the presidency, and the Senate. That's a sweep.
When's the last time, if ever, has that happened?
Probably, if it did happen, it would have been during the Bush era. I don't know. That's not something I keep on the top of my head. But the last time we had a Republican sweep, I don't know if that was in my lifetime. Might have been prior or when I was really young. But that would be pretty crazy. That's the highest. It was like at 24% chance. Not very likely. Now it's almost up to 50%. 40% chance of a sweep is huge. Do I think that would be the best? No, it's good to have a little bit of headbutting. Actually, more stuff I feel like gets done in sticks because typically if we have one side or the other, once the administration switches, a lot of stuff gets undone. So we'll see. We'll see. A balance of power is never bad.
That's for sure. Well, I would love I think we will see Trump. From what he said, he confirmed that it was
he is going to be on Joe Rogan.
Joe Rogan hasn't confirmed it yet, though.
No, but I doubt that Trump would say it if it wasn't.
Yeah.
I think maybe Joe Rogan is probably playing it close to chest and doing what he always does and being consistent so he doesn't come off as being biased or anything like that. But yeah, that's probably going to be, if he does go on that, I think that'll be the most listened to and watched podcast
of all
ever.
Time.
Yeah.
Yeah. I mean, if you look at, I wish I could have seen the sheet that essentially showed all of the podcasts and platforms that he's been on his kind of, media tour the last, call it 30 days. And total aggregation of all of the downloads and views on his stuff was in the billions, and her stuff was like barely breaking into like 100 million.
Well, and he's not spending as much as she is, but I looked at some of the amount of money they're spending, like in Michigan, for example. I mean, he spent like $450 million on ads.
Well, he knows what swing states he's got to saturate those dollars in, right?
Yeah, but it's crazy to see how much money both parties are spending. I mean, there would be billions and billions of dollars spent from
Billions
super PACs
billions
and
of dollars are on the line this next
trillions.
administration. Yeah, I mean, we're in the T's now, right?
Mm-hmm.
But it does look like the markets are pricing in a Trump victory already.
That
concerns me a little bit.
I don't think
it makes me a little nervous.
It's so obvious at this point because she's so terrible and so many people have come. I mean, did you see her Univision thing where the guy literally asked her like, how did you get even elected? You weren't voted for. How did you get elected? Like, how did that happen?
That was the 60 Minutes one.
No, that was Univision. A Hispanic man
was it?
asked her.
I saw the Univision where they were panning behind her, and she's staring at a teleprompter, and then when they realize they're panning behind her,
they turned off the teleprompter.
Like turned it off real fast, and then she starts, you could tell she felt like a fish out of water.
Yeah, in that exchange, during asking an audience member, he was like, how did you become the Democratic nominee because you weren't voted for? So how were you chosen? That's what he literally asked. And she gave some ramble around. She probably said that she was, from middle class and that she, her parents grew up in the middle class and middle class. She probably just started regurgitating her usual lines. Yeah. So she just can't, if she doesn't, and I'm still under the impression because of her performance in the debate versus in any other time after that, she for sure cheated. It's certainly.
Well, you can see the
like
blaring differences.
It's so obvious, and I would never say that if it could not hold any water. I mean, it's so blatantly obvious. She can't even hold a conversation for 5 minutes without walking over herself. Because of that, they just literally picked the worst two. I mean, they started with Joe Biden. They shouldn't have started with him to begin with. Then instead of letting the people pick a candidate, which they probably would have picked Ben Shapiro, that's my guess, for her VP, and then her being the presidential candidate, I think that would have got a lot more leg than Tim Walz.
The stuff that's coming out about that,
I know,
is wild.
And Kamala Harris,
touchdown Tim. He went from tampon Tim from Trump to now touchdown Tim with this whole story, which. I mean, this is like verified reports. I mean, there's documentation in a lot of the archives of this school district that talked about this sexual assault case on him and a young man. And I'll leave you guys up to go do your own research on it. To me, it kind of feels like the Hunter Biden laptop story all over again. The media is not going to touch it. And if anything, they're going to label it as misinformation or disinformation.
I've seen it talked on national media as not disinformation. They're not confirming it, but they're like, this is being talked about and this is not being denied right now by the other side openly. They're not talking about it at all. I think that's the worst thing. If I had an allegation like that was so blatantly false, I would immediately come out and get in front of it and say, no, I did not do that. Instead, when you ignore something like that and don't even touch on it, that to me doesn't indicate you're necessarily guilty, but definitely is not the best look for yourself.
Definitely not. Well, let's talk about last week's CPI and PPI report.
Yeah.
It was, originally expected to be a lot cooler. Looked like it
only came down to 2.4 versus I think 2.3 was expected.
So based on what they wanted, inflation data was a little bit hotter than expected. The labor market data has been stronger than expected. And, is the labor market wrong right now? Like, Americans are, from what the data shows, taking part-time work employment at a record pace, which, in my opinion, the reality is that many people are working multiple jobs to keep up with inflation, keep up with, the cost of living, a lot of the other challenges right now. And so it makes me wonder how strong, obviously our labor market is strong because people are working, but that doesn't necessarily mean people are financially stable
or thriving
and sturdy and thriving, right? And I'll just give you a couple more reports that came in this week. U.S. savings rate are lower than pre-pandemic levels. This was a report that came out through Financial Times. Savings rate set to remain lower than the pre-pandemic levels. They went on, it was pretty long drawn out report that I'll save, but then we saw that small cap companies are struggling. The share of unprofitable Russell 2000 companies is now at 43%, the most since the 2020 pandemic. This even exceeds the 41% seen at the end of the 2008 financial crisis, which also adding to concerns, interest expense as of a percent of total debt of the Russell 2000 companies hit 7.1%, which is the most since 2003, which basically, in summarization, right, just kind of showcases that small companies are struggling to service their debt. They're trying to, kind of patiently ride this out for interest rate relief and seeing some cuts there. Bankruptcies, 5 large U.S. companies have declared bankruptcy year to date, only 6 less than during the 2020 pandemic. Outside of the pandemic, this is the largest number of bankruptcies in 14 years. In September and August alone, 59 and 63 firms filed for bankruptcy, the most in the last 4 years. 3 of the 5 bankruptcy announcements with liabilities over $1 billion were in the consumer discretionary sector as Americans pulled back on spending. So we're seeing corporate bankruptcies at recession levels. Car loan delinquencies. Serious delinquencies on U.S. auto loans are skyrocketing. Auto loans 90-plus day delinquency rates are now at 2.88%, which is the highest since Q2 of 2010. Meanwhile, car insurance costs have jumped by 15% the first half of 2024 to hit a new record high. So it seems like there's some issues going on with the car market bubble right now. So how is the Fed going to handle this data? Because what we're seeing is the economy may be a little bit less stable than maybe people think, but then we see the stock market, and this thing is ripping and roaring and stronger than ever before, it feels like.
Yeah, and that's why the old adage is the stock market is not the economy.
Yeah.
And it's not. And a lot of people correlate them. They are somewhat correlated as far as they're intertwined affections to each other, but they're not the same thing. They're completely different. Although some of the data is not the shiniest and brightest, the car loan market it's just not big enough.
Nothing burger, in your opinion?
Yeah.
Okay. What about small companies and small businesses struggling? Another nothing burger?
Yeah,
I mean, to me, I guess what it says is that, at least on the business side, the bigger companies rule the roost anyways, and that they have so much more market share that even these smaller, us hitting milestones and records that are compared to the 2008 financial crisis or 2020, which we knew what happened in that year. Those things didn't happen this year, yet the data is somewhat reflective of that. It almost shows that these bigger companies, the power, the money, everything is getting somewhat consolidated up at the top, that it doesn't really matter as much as it maybe once did in the past.
I just think that there's going to be headwinds in the short term, especially in the next 3 weeks.
Yeah.
There's going to be some choppiness. But if you look at, for example, like broad market indexes that track these companies, the IWM, which is the Russell 2000 ETF, that was actually the only area you would have made money on the 4 large major indices today. Dow was down, NASDAQ was down almost 1%, and the S&P was down quite a bit as well. NASDAQ and S&P were essentially led by ASML holding company, which makes semiconductor parts, and NVIDIA. And the Dow was led by a couple of components that are not coming to the top of my head. But to couple that, banks just started reporting, and they reported very strong earnings. And that sent bond yields tearing down, that bond rally. So about 1.25% pullback in the 10-year, 1.15% pullback in the 30-year. That's important. So when I see market volatility and I see this, but I see then on the day that the market as a whole is down, but then small caps are up slightly, ending somewhat positive, and then bonds are rallying through the end of the day, that's a positive sign to me. And I think we may get good retail sales data on Thursday, and I think if the market sees that, it's going to push forward and rally again through this catalyst. It's looking for 6,000, and we're going to hit it, I think, fast.
It's going to find it.
Yeah, I said 6,000 was 56.30, and I thought it would take almost till December to get to 58, and we're at 58, almost 50, I think, right today, 57.80, somewhere in there. We're really close to 6,000, so I'm probably going to undershoot it again, which is, I would prefer to do that than overshoot it. But I definitely see it marching towards 6,000. I think we're going to rally through the end of this month. October is going to be awesome. I think we're going to have a modest November. I think what's going to happen is when Trump wins the election, it's going to, I'm not jinxing it. I'm just telling you what the data says right now. If the data is right, Trump wins the election.
If he doesn't win, I've lost all hope in democracy and free and fair elections.
Yeah,
We'll digress on that.
Yeah, it doesn't look like it's going to be something that can be quote unquote rigged if that would happen.
He said too big to rig is what he's been posting, but all I know is if there's a way to do it, the left has shown they will do it.
I think it's going to be a good year. And now 2 years in a row, investors would be rewarded and will continuously be rewarded for ignoring the noise.
Yeah, because there's been a lot of noise that I know a lot of people. You know more than I do. I know you talk to a lot.
Where's the housing market crash? Where's the constant recession? Where's the 2008? Where's the beginning of this year? Where's the collapse of the financial system because 4 regional banks went down? I mean, the stuff that's kind of pushed. I mean, what I tell people is if I'm worried about money, you should be worried about money. Because I have a pretty thick filter for things to get through before it bothers me. A lot of this stuff is just normal.
Yeah.
Not that people want to go through it, but it's normal.
Well, it seems like, people are all in on the stock market. The bullish sentiment is at record levels. I saw this report today, which I thought was wild. U.S. households now hold 48% of their assets in equities, which is the highest since the 2000 dot-com bubble peak. Since the 2020 crash, this has risen by 13 percentage points as the stock market has rallied 160%. Over the last 15 years, this percentage has doubled. Interestingly, Americans' allocation to bonds and cash is just 16 and 15% respectively, well below their long-term averages. So, to me, right, I mean, what is...
Risk appetite is just increasing because the understanding of that you have to take risk for reward is becoming more and more evident.
That, and I mean, just look at the data. If if you've been in since 2020, you've experienced 160%, or you've shared in some capacity of that 160% upside.
Yep.
So people are getting rewarded. I guess the little devil on my shoulder says, well, if half of people, 48% of their assets are in equities, which is the highest since the 2000 dot-com bubble peak. And I think, have heard many people try and make arguments, the bears out there, right, that we're in a bubble, that we're going to see a pullback or a crash. That could be something that could wipe out a significant amount of wealth for people if something were to happen pretty drastic in the stock market.
Absolutely.
If, right?
Yeah. It could potentially happen. It just probably won't.
Yeah.
Anything bad can happen. It just probably won't.
Yeah. I mean, the inflation component here, I wanted to get your take on. So BlackRock CEO Larry Fink says the market is pricing too many interest rate cuts from the Fed given the U.S. economy continues to grow. Prediction markets now see a 15% chance of no rate cut in November, according to Polymarket. Over the last 3 weeks alone, odds of a 50 basis point rate cut in November have declined from 53 to 8. Likely let's call it a 25 basis point cut, much more likely. I've even seen people say they don't think there's going to be any more interest rate cuts this year.
Well, that would just be...
And here's
I don't know what people... I mean, literally...
Here's one theory.
No, yeah, let me hear it.
You ready?
Yep.
The hurricane. So massive demand for building materials to rebuild, creating pressure on pricing and inflation.
Nope.
Significant job creation to rebuild everything and wage growth to attract talent. More inflation. Housing stock knocked out of supply, which actually was the first time we've seen, I want to say this week, for the first 4 or 5 months, over a percentage drop in inventory. So we've been seeing an increase. We saw it retract pretty significantly this past week. Now, whether or not that has to do with housing supply and what happened in Florida and Georgia and North Carolina and all of that, but basically their argument, right, is more inflation pressure on rents, housing prices, more inflation pressure on jobs, wage growth, and materials and services on top of already strong job numbers that came out last week.
No. Next.
Any expansion on that?
No, it's
not big enough?
It just doesn't. No, it's not. It just is not big enough. Florida is not the stock market. Florida is definitely not the
So what
economy.
about this, the no landing scenario?
We already hit a soft landing.
We did.
Also next.
Okay.
This is how fast you can filter through the bullshit that's
Yeah,
out
because
there.
this one says the no landing scenario, a situation where the U.S. economy keeps growing, inflation reignites, and the Fed has little room to cut interest rates, had largely disappeared as a bond market talking point in recent months.
We hit the soft landing confirmation 2 weeks ago. pretty much, and then last week.
How do you
with BP.
quantify that?
Produce just the overall trends and stuff. We are going to have little spikes. Things don't move in directions in straight lines, so things don't go straight down when they go down, and they don't go straight up when they go up.
Yep.
But everything is trending down. And when I look at real CPI and I remove a lot of the flack and the data that doesn't matter, we're well below, almost at like 1.4. So this is all just fluff.
So what are your thoughts then on if the percentages of a rate cut in November have dropped relatively significantly?
They haven't. They're at 97%.
They're still going to cut.
They're at 97% chance of a 0.25% cut. They haven't dropped at all.
Or sorry, that was the 50 basis point.
Yeah,
Right.
I don't think there's going to be any more 50 basis points.
So you'll think they'll do the 25.
Yep, they'll do 3 more 25%. Or excuse me.
2 more.
No. 1, 2, 3. 3 more.
October, November, December? You
Yep.
think they're going to do all 3?
Yep. And then they'll cut again in January, and then they'll pause until March. That's my guess right now.
Okay.
That can change, but they got the 51 out of the way. I don't even know why they followed up with, we'll cut again by 50 if we have to. I think they were just reassuring the market that wasn't their only 50% cut that they would have.
Mm-hmm.
But they were either going to do that then, which nobody thought, or they were going to do it in December, which is what the majority of people thought, because that's what they've typically done, is done at the tail end of the cutting cycle. They started it, they front-loaded it. We've all but confirmed that we've kind of initiated and been in a soft landing scenario. You can tell by what the market's doing. The labor market's not secularly tight anymore. Unemployment's trending up a little bit, but not too high. Everything is pointing towards that we're in a soft landing scenario. No landing, maybe, but soft landing definitely is I think in the works. And JP Morgan, one of the largest U.S. domestic bank, is also behind that on that call as well.
Got it. Well, we talked last week about the American dream costing $4.4 million, right? And just kind of how crazy that number seems and feels based on some of the data that was included in it. I saw this recent headline and wanted to get your take on it based on the fact that I know you talk and plan very specifically with a lot of people about their retirement.
Yeah.
Right? And a lot of people, pending a lot of our conversations that we've had, say, hey, here's how much money I'm willing to invest and what this looks like, but I want to retire with X. And you go, well, there's a disconnect with that, right? We got to make sure that what you have available and are willing and capable of doing going into retirement actually aligns with this goal, right?
Yeah, it's got to be quantifiable.
So about 45% of Americans who leave the workforce at 65 are likely to run out of money during retirement, per Morningstar's Center for Retirement and Policy Studies.
Yep.
Why is that? And what are people missing there that they should be thinking about? Whether you're 25, you're 40, or you're 60 and you're planning for retirement, what is something that people miss along the way with that plan that leads to 45% of those people when it comes to retirement time?
Yeah, normally it's really like 2 things. One thing that stands out a lot is not saving enough. So a lot of people think that they can generate a lot more income with values than they can.
Right. So you either need to find a way to generate a lot more income, because most people don't have a plan that's tangible for them to do that.
Correct.
Okay.
Second reason that most people run out of money is they try to self-manage, and it's easier to self-manage when you're accumulating assets because you typically have a longer time horizon before you're distributing assets. So the accumulation phase of most people's life, which is the majority of their saving years, is the easy part. The hard part is the distribution phase, when you have to take those assets that you've accumulated, continue to accumulate them without any additions, and in fact with subtractions.
Yeah.
And you run into risks there that you don't deal with in accumulation planning, like sequence of withdrawals risk, where you can take the same rate of return, let's call it 9%, but in a different order. And one way that you get that 9% rate of return, you make money, and the other way you get that 9% return, you run out of money. It's a sequence of returns in the order that you get them. So taking large losses early on in your retirement is a big no-no and a big deal you got to try to avoid. Lastly, our parents and our grandparents had a lot of pensions, and so they're like 3-legged stool, which really had like 2 legs, was like Social Security, pension, and you would fully retire on that, and you really didn't have investments because you didn't need them. Your house was an investment technically, and you maybe had a little bit of money in the bank, but you had these big pensions and these big Social Security benefits. Now, with the advent of the 401k, pension plans through work have gone by the wayside, and people are then forced to save for themselves for retirement and then consistently do that instead of a company doing it on their behalf and not the employee taking money out of their own pocket. Because of that, there's less people that volunteer to do that because it's a voluntary plan. You don't have to do it. And then when people get to the retirement desk, they have too much of their money at risk where they're not using like annuity products to kind of cover some of their income gaps. And Ernst & Young did a really strong study for retirees that said most retirees should have at least 30% from a data standpoint of their assets in an annuity, if not more, depending on their risk tolerance. The legal limit is around 70%. But most of the time when I meet with retirees, I show them kind of doing both, but the data supports that you get the highest income and the highest legacy value off in balance, off of using some of your money in an annuity, some of your money in the market, and then covering the rest with your Social Security and or pension. And people are just resistant to that because there's bad information on, just like there's bad information on life insurance and bad information on annuity products, bad information on commercial investing, there's bad information everywhere. And so it influences people to not make decisions for themselves that could be good for themselves, because an annuity is essentially a private pension. It has an income stream. You can't run out of money. It balances out your portfolio for risk, so it keeps your risk budget in line. They're not a silver bullet, but they're a really strong tool that help us so people don't run out of money, because those plans are guaranteed for the lifetime of either you, or if you're married, you and your spouse.
Yeah.
So those really are the reasons. It's poor investment decisions and lack of education to make correct ones, and then not using an advisor and typically being resistant to implementing products that can help, because you come into an advisor to ask for help and then you get told what to do and then you're resistant to the information.
Yeah.
So a lot of people just got to get out of their own way. I have tons of people that I retire. We retire hundreds of people a year. And the people that listen to me and that listen to us, the feedback that they would give is, we really have like a stress-free retirement. That's kind of swan effect that we've talked about in the past. They sleep well at night because their income is mostly or fully guaranteed. Their investments are secure and safe. They know what they're doing. They know what they're paying. That's what we do the financial x-rays for. And that allows them to just worry about every day being a Saturday.
Yeah.
That's really what retirement's about.
When somebody comes to you and does the financial x-ray, what are some of the things you see often that can easily be adjusted and realigned to help avoid some of those pitfalls?
Poor allocation, and typically from a more technical standpoint, negative alpha.
So what does that look like?
That just means that you're taking high risk, or you're taking risk and not getting in return in an equivalent fashion.
Like they started on one path and they didn't take the time to revisit and readjust based on kind of where they're at in that journey?
Kind of, but even more specifically, they bought a growth stock, but it's acting like a bond. Or they bought a bond and it's risky like a growth stock. So it's not doing what it's kind of really designed to do, and that throws off your efficient frontier and makes your portfolio inefficient over a long period of time. The other thing I normally see, and I just dealt with somebody that had been with their advisor for 10 years, was really resistant to saying, I don't know, I don't want to leave him. He's been good to me. We've been going to and I said, just take a look under the hood, because then when we look at it, it'll just give you the data to help make that decision. Well, they were paying 3.75% in front-end loads that they didn't know about, and they're paying almost 2.25% in advisory fees because there's a bunch of layered fees that weren't showing up on their statement.
So over 5%?
It was 3.75 on the way in, and then about 2% annually.
Okay.
So only new money gets that. The new money comes
that one
in.
time.
Yeah, so it's like a load, a commission.
Got it.
And then it's an ongoing. And that's just a lot of money.
Yeah.
I mean, most of our clients are all in for somewhere around 1.2%, like an 0.85% advisory fee. That's what I charge people typically on advisory fees. And then normally about a 25 to up to 40 basis point expense ratio on top of that. And that's a fair fee to be paying. I know people say, you go buy a low index fund and you can do fine without a financial advisor. That's bullshit. The data actually does not support that.
The best of advisors, especially since I've come over to you, obviously a long time ago, but it's been worth its weight in gold and then some, right?
Yeah, because you don't have to do anything. We should be earning our keep. I can't speak for everybody that doesn't. And there's a fair amount of people that don't earn their keep. I can highly advise if they have a big box firm or an insurance company on their card or behind their name, those are probably people you want to stay away from. That's where you're going to go to Baskin Robbins and find 31 tubs of vanilla. It's not going to be really specialized advice for yourself. There's a lot of independent advisors and RIAs like myself that do a really good job. Overall, though, it's fees and poor allocation and then lack of an implementation on a plan. Or people have investments and they have no financial plan. So they have I have a brokerage account and I have this Roth and I have this insurance and I just put money in them. Oh, what's the ultimate goal with that? I have no idea. I just put money in them. And they don't even actually know what that can look like.
Yeah.
Maybe they're not putting enough. Maybe they're putting too much, or they're putting so much that they can reach the goals 7, 8, 9, 10 years earlier. Those are the things that we uncover through that process. And that's people just don't do that. I don't know how you can go and give your money to somebody that doesn't build you a financial plan, and or if they want to build you a financial plan, they require you to pay them thousands of dollars to do so prior to knowing what they can do for you. We just don't do that. We just do a no cost, no obligation. I want to see if you're a good fit for me. You want to see if I'm a good fit for you. And we can figure that out through this process without having to, you have to share information and data. I have to give you the data back and information. And if it aligns, it aligns.
Yeah.
If it doesn't, it doesn't. There's no harm, no foul. But
Yeah.
it gives you the power to make an informed decision and me the scope to say, yes, look, I can help you.
Right.
Here's how I can help you and why.
Yeah.
So that's typically what we uncover, typically what we go through, and typically why we do it.
So when somebody texts the word X-ray to 844-447-1555, this is basically the process that Ryan offers for free for everybody that wants to take advantage of that, right? Look under the hood, so to speak. What does that entail for them, right? Because a lot of people are like, I don't want to have to do all this extra work. And
so most people have investment accounts and our insurance. So hey, Joe and Cindy, how old are you? We're in our 30s, our 40s, our 50s, our 60s, our 70s. No age limit. Here's our investment accounts at Vanguard, Fidelity, Edward Jones, so-and-so. Here's my work retirement accounts. Here's what I'm going to get from Social Security if they're old enough. If they're younger, here's when we want to retire. I have a lot of people that say, I want to retire at 50. Great, what are you doing? We're maxing out our 401k. Oh, probably should stop doing that because you can't touch your 401k until you're 59 and a half. That's not aligned with your goals. And they say, oh, I've been saving almost $35,000 a year between me and my wife in that account. And I said, well, that's great. That'll be good when we're 60, but that's not aligned with what your goals need to be. We need to redirect that into like a non-qualified investment account so that you can start saving there, because that account will need to be structured so you can use it when you're 50 or 55 or 52 or whatever you choose. So that's the type of stuff we go through during that process. I think the number one thing that I see too is like people contributing, if they are to their 401k, they do it wrong. They front load the plan throughout the end of the year and they're actually missing out on a lot of company match. They think, oh, I can put $19,200, so I'll just do a lump sum and I'll get my max match. If you actually spread that $19,200 or $20,000, whatever it is for you, over the year, you'll get more company match from your company versus than doing it all at once. So there's all these little nuances that we're just not trained to do in school. And that's what going through that X-ray process allows us to identify. And again, it's based on your goals. What are you trying to do? How much income do you want? What's your investment risk tolerance? Are you conservative? Do you like real estate a ton? Are you somebody that needs to use insurance products? Are you already using insurance products? Is it not performing well? We just go through a really in-depth process, and typically the final plan is 110 to 150 pages that we'll go through in depth so the person knows what they're doing.
It was great. I loved it. Loved every step of the process. For those of you that want to take advantage of it, free. Again, you can connect with Ryan and his team, X-Ray, X-R-A-Y, at 844-447-1555. I mean, I'm a little disappointed in you that, you're not getting me the returns that Nancy Pelosi's getting.
Yeah, man. I want to pull the insider trading.
I just saw her portfolio has had a new all-time high. She has made millions this year alone. She has made likely $3 million alone as of, this was a Monday. So in one day off her NVIDIA.
She was down a shitload more than we were today.
Was she?
Oh, yeah, probably 7%.
Basically, she had 3 pretty big stock option positions that she cashed in on, making a little over $3 million and absolutely crushing it. So we'll keep her in our crosshairs so we can make sure.
I wish.
Are they ever going to do anything about that? I mean, I saw.
Yeah, turn of the year. It's a lot. Turn of the year.
Is it really?
Yeah,
it got
passed.
finalized.
Oh yeah, it's signed.
It's funny. What's his name? Ro Khan or Kana, the guy who introduced it, and he, referenced unusual wells and how they track all of the politicians and their insider trading. He was on the list like 2 weeks later for doing the exact same thing, and so I just thought it was very ironic and funny that the guy that's trying to stop it and was all up in arms about it. He's like, hey,
I'm gonna hit this really quick before it's gone.
I'm getting mine real quick too. So. Just not a ton of, real estate's been pretty quiet, to be totally frank.
Yeah, we have our ear to the ground for the crash. We're waiting for it. Don't worry, guys.
There's home prices are up 42% since 2020, but because both rates and borrowing costs have skyrocketed, you need to earn 80% more to comfortably afford a home in today's market. This is still obviously a very, very clear issue that
affordability.
There really is not a lot of paths forward that are going to alleviate this problem expeditiously. Now, we've heard both candidates talk about incentivizing building and delivering, 3 or 4 million homes. I see a lot of red tape, a lot of different layers of the kind of laws that need to get changed and manipulated in a way that will actually incentivize and support those goals being achieved in the time frame that they're trying to hit it on. So
I agree.
We have seen, obviously those that are sitting in houses benefit significantly from it in terms of ownership, but that ownership, being in reach for a lot of people is starting to seem a lot further away. So,
well, even for homeowners, my tax bill has gone from when I bought the house back in 21 from around $13,000 a year to almost $19,000 a year.
Yeah,
and
all my property taxes have gone way up.
That a lot of people are like, "Oh, the home's appreciating." It's like, yes, but I am paying for it.
There's other expenses that go along with that. Energy costs are up. Insurance costs are up.
Home insurance costs. Thank God I haven't had a claim.
All of it.
Yeah, because people are getting dropped left and right too. It's a difficult time to try to buy a home, and if you're a homeowner, and like myself, I'm a homeowner of the past 5 years, right? I don't have 12 years of a mortgage under my belt, so I've paid off half of my mortgage or anything like that. It's expensive.
Yeah,
you're constantly paying down the mortgage, but then the freaking tax rate is skyrocketing. So my mortgage has literally gone up. When I bought my home, I was paying about $5,300 all in. I'm at like $6,100 a month all in right now.
Yep.
And that's a huge monthly expenditure, and when only $4,300 of that is going towards that's going towards the loan.
Yep.
That's crazy, man. That's a huge expense. So it's really expensive not only to get into the housing game now, which will be alleviated with interest rate cuts to a degree, though.
Yeah,
because housing prices, I don't know if you guys look, just like I'm going to tell you about the stock market, they may pause, they may go down temporarily. They will never stop going up over the long term. The longer you wait, I try to tell this to people that are, hey, I'm going to rent for a year and then I'm going to buy. Just fucking buy it.
Yeah.
It's scary. It's one of the scariest things I ever did because it's the most expensive thing I've ever purchased was a home, personally for myself. But if I wouldn't have taken that leap, I wouldn't be in my house today. It was a huge jump by almost $2,000 a month higher than my normal expenses were. I figured it out.
Yeah.
A lot of people have figured it out before you, and you will figure it out as well. You just have to make sure that you take that leap and you do it with good faith and with a plan and with a good job and steady income. You'll figure it out. I promise. Just like all the other expenses you tied into your life for the first time.
Well, as we wrap up today, I saw this little soundbite that I'm going to play for you guys, and hopefully, Tone, you can pick this up in the mic. But for this I thought summarized, at least it spoke to me, because I think a lot of people think they need to know everything. They need to have the entire plan figured out clearly, whether that's on paper or in their head, to be able to start taking action towards something. I know most people want financial freedom. They want abundance. They want to build wealth. They want to create a better life for themselves, for their spouses, for their kids, for future generations. But oftentimes it's the not knowing how to do it or not having that vision crystallized that prevents so many people from just doing the simple things and figuring it out along the way.
Analysis paralysis. And
this, I thought, resonates in such a big way in terms of if you are, and you hold the key to your financial destiny, and I'll recap it after this.
97% of millionaires in the study believe they control their financial destiny. That was a shock they even put that question in the study, but it was such an empowering one because it's less about money. It's more about belief. And what the limiting beliefs we have about well, I didn't grow up with money. Well, my parents made money mistake. No, you don't understand. I got baggage, man. I made too many mistakes with zeros on the end. And too many people live their life with that Eeyore mentality. But 97% said, I believe I have a sense of control and autonomy and agency over what happens with my money. 97% of...
So to me, that just resonated in the sense of if you believe that you're going to figure it out, and you just kind of take action, and my quote that I've always said for myself is just, I'm just dumb enough to believe in myself and smart enough to start moving in the direction that I think is going to help me achieve my goals. Mm-hmm. I don't have to have all the clarity and all the plans and X's and O's. And you want to, when you can be in that situation and scenario, it feels better. It's definitely a lot easier. It's more efficient and effective, but that's not always going to be the scenario in the case, especially when it comes to making money.
Agreed.
I mean, there's a lot of times where I'm I don't know if this is a good decision for me, but Breedwell, here's the money, right? I don't know if this is going to be a good, investment. I think it's going to be a good one. I don't know if this flip is going to pan out the way I thought it was going to, and it did. Or maybe it didn't, but the lesson that I learned helped me make twice as much more back on the next one, right? And so it was just more of this belief of no matter what, I'm not going to be denied. I'm going to get there. I'm going to learn. I know I'm going to fail along the way, but I believe in myself that I can figure this out. I'm capable of it. And when you look at that study, that 97% of the people on the list of millionaires said, I believed it. I believed it before I became it. And so I think for anybody that's listening, it's just a great reminder, right? Of most important is not about 100% knowing for certainty that you have the formula to get what it is that you want. It's that you've got within you the belief that will allow you to find the formula over time.
Yep.
Right? And that's just figured out through action. So a great way to wrap up today's episode. Thank you guys for tuning in. We'll see you in next week's episode.
Cheers.